Okay, let's go back to the implied volatility skews seen in lesson 20. Okay, do you remember this was the skew of the implied volatility of puts and calls? And in this particular situation, we had the skew of the call higher than the skew of the puts. Okay, it's a peculiar situation that sometimes shows up. Not very often, but it happens. Okay, so what can we make of volatility skews? How can we take advantage of volatility skews? To complete what we have seen so far, it is useful to specify that there are three types of volatility skew, each of which represents a good opportunity for the construction of specific strategies. We can have price skews, when options with the same expiry have very different implied volatility levels on different strikes. This skew can occur in two different and opposite ways: direct. The highest strike options have higher implied volatility than those with lower strike prices, and this is the best situation to build put ratio back spreads. For example, since the caps are paid little and is received much from the sales. Or we can have the price skew reverse. The lowest strike options have higher implied volatility than the high strike options. Here, call ratio back spreads could be interesting. We can have type skews when there is a volatility differential between puts and calls on the same strike and on the same maturity. This may happen when a certain stock was recently in the spotlight and therefore has a very high level of implied volatility on puts or calls to indicate market fears on the bearish or rather on the bullish front. Situations like these may generate opportunities for naked short selling. Time skews, when the implied volatility of a maturity is very different from that of another maturity. A typical case is when there are rumors, for example, about a possible takeover, or you are in situations that involve an increase in the implied volatility of options with shorter residual lives, but that do not affect the most distant maturities over time. Situations like this often arise on options on American stocks when approaching the communication of corporate hedgings, and here calendar spreads could be interesting. Different types of skew can even occur simultaneously. Let's look back to the skew in slide 174, the one seen in lesson number 20, this one. It is both a price skew and a type skew. Why is that? Because we have significantly different values of implied volatility among different strike prices, and we have different volatilities between calls and puts with the same strike prices. So it's at the same time a price and a type skew. Indeed, not only the lower strike prices show a much higher implied volatility in respect to higher strike prices, but the implied volatility of calls is generally higher than that of puts for all the OTM strikes, and vice versa for the ITM strikes. How can an event of this kind be interpreted? To short sell ITM calls is pointless, no matter any other reasoning. So the high volatility is very likely the reflection of a high demand for those calls. Since ITM calls can be used to buy stocks at some future moment by spending less money, remember the leaps, there is probably a certain upside expectation on the underlying security. Selling ITM call doesn't make much sense after all. So this situation must be looked at from the buyer's point of view. The reading of the put data, on the other hand, is more ambiguous. High implied volatility means fear of a near future fall in the price. But it is also true that a high implied volatility attracts short sellers who can take advantage of the premiums higher than usual to collect more. Who is right then in such a case? Who buys put at a high price because he fears a fall, or who sells it short because the premiums are high? It is difficult to reach a verdict after observing a single data. We are entering a rather complex field where the analysis of flows is much more useful than the analysis of isolated data. It is certainly much more efficient to base your trading decisions on the evolution of a skew than on their form in a single moment. All seen in previous slides leaves room for some final notes about implied volatility. In fact, given the fact that if an option is worth more than normal, it means it carries a high implied volatility. With it, one could ask himself whether the high volatility is the cause of high premiums or vice versa. Indeed, strong demand for something causes its price to increase. If many investors think that the price of a stock will increase significantly over some time period, they could either purchase the stock or buy calls in order to save liquidity. As we know since lesson 11, the calls that react the most to the price of the underlying are the ITM ones. So a way to reduce the need for money and keep almost all the benefit of a price growth in the underlying could be the purchase of ITM calls. High demand of such calls would then make their prices increase, and the same would apply to their implied volatility, but as a reflection, not as a driver. So in the end, the point is that we need to take care in interpreting data in front of us. High volatility does not necessarily mean high perceived risk. Once again, it's not a spot data that gives us an advantage in interpreting the possible future behavior of the underlying, but it's the evolution of all this information.